75% stocks, 25% bond during the bull market. 25% stocks and 75% bond during the bear market to help smooth the ride, according to Ben Graham. In my opinion, Graham's view is sustainable. Why? Because bonds are not affected by the daily up and down movement in the market, unlike stocks. And bonds generate a predictable and regular payment semi-annually. Bonds are often liquid, hence they are considered a safer investment than stocks. Welcome to my channel and please subscribe. Thanks. Bond is a debt contract or obligation, if you like, between two parties. The issuer of the bond, the borrower, and the investor who invests in the bond in return for a payment as interest on the asset, which is known as coupon payment, meaning the borrower is obliged to pay the investor a consistent and predictable payment within a set duration. To be more specific, let's say a bond is issued by a company called Blue Diamond with a fixed coupon rate of 3% per year, maturity date 3 years, and a principal of £2,000. The bond can now be regarded as an IOU contract between the issuer, Blue Diamond, and the investor with a duration of 3 years. Remember, the coupon rate is at 3%. It works out to be £60 per year. And bonds usually pays out coupons semi-annually or every 6 months. In effect, the investor will receive £30 as coupon payment every 6 months over the 3 years duration. And when the contract matures on the set date, the investor will also collect the principal value of £2,000. And again, once the bond is issued, it can be traded on the secondary bond market. Meanwhile, the price of the bond during trading could move up and down, say if and when government cut the interest rate. And if price moves above par during the period, the bond is trading at premium, and if below par, it is trading at discount. However, at maturity date, the bond will convert to par. The key point is stay invested during the roller coaster till maturity date. You will receive 100% par at maturity. What is par value? First amount of bond which is paid at maturity. And you should be aware of risk as you buy bonds. And don't forget the important principle of investment. Higher returns attract higher risk. In effect, risk motivates the return on asset. Shares will generate highest return, hence attract high risk. Fixed deposit perhaps earns the lowest return because it is considered to be safe. Meanwhile, bonds can also vary in risk and in returns. The AAA bond is the best bond you can buy. Why? Because it is deemed least likely to default, while the medium and the lower bonds are considered to be speculative because they are embedded with high credit risk, meaning that there are some elements of risk with bonds, and the higher the risk, the higher the returns. Lower risk, lower returns. And the longer the maturity date, the higher the return, because your money will not be available to you for a longer period. And the shorter the maturity date, the lower the return because of the short maturity date. And government bonds like treasury bills, etc. are much safer than corporate bond. Corporate bond attract high tax, while government bonds like municipal bond adds tax advantage. There are secure and unsecured bonds. For instance, a secure bond is backed by some asset of value like building, equipment, and trust certificate. The issuer of the bond can pledge any of them as collateral that can be claimed by the investor in the event of default, while unsecured bonds are not backed by any physical collateral or by government. And because of the credit risk embedded in the unsecured bond, you will be compensated with higher returns. Here is the key takeaway. Stocks appreciate faster than bonds and attract more risk. Meanwhile, bonds, which are loans to government and to a reliable company that issues them, are often referred to as good investment because of the steady income it generates. Meaning, you should understand the particular security you invest in. Here is the best part. Subscribe, like, and comment below. The goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.